Hi, and there's the man. So, hey, Hector. I think
Hey
we
Scott, how are you?
good. I'm getting microphone envy.
Actually, this microphone is $60. It's
Oh,
actually the
really?
best microphone. I've had microphones from $30 to
Hector, we can't hear
$300.
you. Hold on. I'm sorry, Hector. Is your audio? No, I'm just messing with you.
Okay. I said I've had microphones between 30 and $300, and this $60 microphone has been my favorite so far. I do a lot of webinars, so I really like it.
Yeah, well, you're coming through loud and clear, and so that is certainly key. And on that note, why don't we go ahead and get started? It's a minute past the hour, and Hector, I don't want to steal your time, but if the microphone wasn't an indication that Hector does a lot of broadcasting, I actually can give you some stats behind it, Hector. I was actually looking at our site just to see how many registrations we've had for classes that you've hosted, and we're in excess of 22,000 at this point. And so this class that we're looking at today is actually the latest and greatest, and we appreciate everyone signing up because it hasn't been posted to the class or to the site for a very long time. And so anyone who's registered did so really just in the last couple of days. And on that note, I'd actually like to pose a question to the audience, which is what brings you to the session today. Have you taken a class with Hector before, either on value pricing or on QuickBooks Online or or desktop, or so many sessions that Hector's offered? Would love to know what your main goal was of participating in this course. And I also just want to let you know that we're really grateful for Hector presenting this class. He was sharing with me fairly recently a much more extensive offering on value pricing that he's doing as a deep dive. And when I found out about that, I wanted to make sure that our members were aware of what Hector was doing and how much content he had to share specifically in this arena. And he really does some groundbreaking work and does his homework and networks with all the right folks and really studies what's out there and what's missing from this conversation. And actually, as I look down at the first comment from Alexa right now, it's because Hector really knows his stuff, and she's in the middle of repricing, so she's trying to absorb all she can. So that comment just came in from Alexa, and I think that's the sentiment for this class, the key. So if you're not familiar with Hector, I'd certainly encourage you to keep an open mind. There's always something new to learn, and I think the most interesting aspect of this class is that it's on value pricing, and here's this revelation that in order to make value pricing work, you actually have to be able to provide value. Maybe not so obvious to everybody, but that is today we're going to explore perhaps what's missing with some folks when they want to switch to a model but maybe don't have the foundation for doing it. And so I think we all have something to learn from this, and my goal here would just be to make sure everyone knows specifically what to expect in terms of CPE, since this class does qualify for 1 credit. The rules of engagement are really simple. We have 4 polls. That's actually 1 more than NASBA requires, so if you miss one, not the end of the world, but please respond to them as quickly as you can. They really are helpful for first of all, for helping us get to know you, and what your expectations are for the class, but also because we can speed through them more quickly and spend more time on the content and hopefully questions at the end. And I do want to encourage people to ask questions. I'm not just saying that. Please post them to the question panel. Put us to the test, see how many we can get to, but we will be leaving time. And if there's one person who I know can multitask, it's Hector. I think I've actually seen him do 3 things at once, which is a record. So anyway, Hector, that's all I wanted to say. As always, it's a pleasure to have you. I'm going to turn off my webcam and we'll turn it over to you.
Thank you, Scott. So as my name is Hector Garcia. I'm an accountant, a QuickBooks Pro advisor. My office is in Miami, but I do work really all over the world. And value pricing has become my passion in the past 4 or 5 years, particularly because I spend so much time doing non-billable work. I mean, the 20 to 30% of my time, I'm doing things that most accountants would say it's impossible for me to do because I have so much work. So I've had to adapt value pricing because it's the only way to have a sustainable practice while I am not doing 40, 50 hours of billable work each week. And this is not a get rich quick scheme or anything like that. It's just pricing your services better. So when you're not doing services, you are creating value, so then you can price your services better. And it's just a very positive cycle. So that's really the genesis where this came from. So in this first 5 minutes, we did introductions. Scott did a pretty good introduction. I'm going to talk about a big webinar that I'm doing on August 30th. It's a one-time webinar that I'm doing. I may repeat it if there's enough demand for it. And that's really what I'm here to promote. I want to give you a 45-minute Reader's Digest version of what that webinar it's all about. And that's what this particular webinar you're watching live now is. And it's really just to discuss understanding why hourly pricing is so popular. Because what I really like to do is I like to debunk why value pricing is quote unquote easy, because value pricing sometimes is seen as hard. So that's really what I want to do. But what I want to really focus on is the 6 opportunities to create values for your customers. So this is where you're going to be focusing your time to creating value, to then allow value pricing to follow the value you create. So it's not forcing the pricing onto your customers, it's naturally pricing it because you have to. The customer's gonna, it gets to a point where customers say, why are you charging so little to do so much? And that's really the position you want to be. You want to be in the position where the customer almost feels bad for paying you so little. So in value pricing, the methodology and the mindset helps you have the confidence to do something like that. And then we'll leave 10 minutes for Q&A, because I really want to encourage you to ask me your questions so I can cover and your concerns and your challenges with the topic. Okay, so there's my email if you want to email me directly. Any questions you have about QuickBooks or business advisory or pricing as a whole, you can always email me, hector@garciacpa.com. My doors are open. As long as the email is answerable, you will get an answer from me. So real quick, I'm just going to plug this real quick, and then I'll talk about it towards the end. On August 30th, it's a 3-hour webinar. It's a paid webinar. It's $300. There's a $50 coupon just for folks that sign up before August 15th. So before August 15th, at the end of the day of August 15th, $50 off if you put the AUG coupon code. You click on that and it'll give you $50 off. Otherwise, it will be a $300 webinar. I'll talk about that more in detail towards the end. So these are the topics that I'm going to cover in that big webinar, which is basically a much expanded version of the one that you're watching live through CPA Academy. For the most part is how to create value and some specific examples on simple techniques on how you can create value. So when you're having that conversation about pricing with your client, it just makes it much easier. So I'm going to give you some of the contents from that webinar in today's webinar, but of course, I'm encouraging you to take my paid webinar, because that's really what I'm here to promote. So we're going to talk about where do I get my inspiration and resources for value pricing, because I recommend that you seek out the same resources. I'm going to dive into why hourly pricing is so popular, the 6 opportunities. We'll talk about some general rules. And then the last thing, I'm going to show you one tool that has really completely changed the way I price my complex projects. And this is probably the most popular one of all of them. So I'm going to show you this one because you're going to walk out with something really nice. So these 6 books I recommend: Implementing Value Pricing, Value-Based Fees, Positioning for Professionals, Let's Get Real, The Experience Economy, and Flawless Consulting. These 6 books as a whole really kind of summarize this whole presentation and my philosophy, plus some great podcasts to follow, which are listed on the screen. I recommend that you follow those podcasts because they do help you get your mindset going on value pricing. On the resources page, there's going to be multiple resources. There's a couple of cheat sheet guides that I created, some links to other webinars, some PDF documents for package pricing, Ron Baker's Pricing on Purpose 21-page guide. All those resources will provide tons of context if you want to expand on the topic. So make sure you check them out. They're on the resource page. So let's start. Why is hourly pricing so popular amongst practitioners? And the first thing is I want both of us to see eye to eye in why we gravitate back to hourly. Why are we stuck in hourly? Number one is because the risk is shifted to the customer. That means the risk of a job taking too long, a risk of you not knowing how long it's going to take upfront, the risk of having some unknowns come along the way, the risk of sometimes tax document that came out of nowhere, and you have to call and manage it, the risk of you having to deal with third parties to answer questions about accounting, all the risks associated with the work that the accountant has to do is shifted to the customer. That means if something happens, customer, you're going to pay for it. And the way you're going to pay for it is with my hourly fees. That's why it's popular. The other one is it's easy, and I'm doing air quotes here, it's easy to measure for profitability. Most practitioners think, and I'm going to debunk that with a spreadsheet that I sent you. It's easy because most people think, well, if my employee gets paid $50 an hour and I charge $100 an hour, I'm going to have a constant $50 an hour profit on this employee. And I'm going to explain to you why it's not so easy. The other one is it's easy for pricing and quoting. If somebody calls you over the phone and says, hey, I need a new accountant, how much do you charge? It will take you 3 seconds to say $250 an hour, or a second. I don't know how long that took. It's easy to price and quote. The problem is it just doesn't provide any context, because the customer's always going to say, well, thank you for telling me that, but I don't know how long it's going to take you to do the work. So the hourly rate doesn't mean much, right? Also, it doesn't require much thought. It's just a number pegged to time. And also, and this is another challenge that we have, especially experienced practitioners, the ones that started at $50 an hour and now charge $300 an hour. That rate becomes a status symbol. And that's the symbol that I grew, that I'm popular, that I have demand, that I'm needed. And for a lot of practitioners, it's hard to let go of that status symbol. And I'm here to welcome you to forget about that. That status symbol is completely useless. It's actually going to be counterproductive to your overall profitability. So, this is why hourly pricing is so popular, I think. So I'm going to open up a spreadsheet that I created, and it's on your handout. And what I want to show you is that sometimes it's not so easy to calculate profit on hourly rates. And for the most part, because we have to calculate overhead, we have to calculate usage. So in this spreadsheet, what I've done, and you can play with it yourself, I created a quick list of my expenses. These are my office expenses or my overhead, whatever you want to call it, right? So that's what the first is, and you can modify that and enter your own that has to do with your practice. Then on the second box, I entered the owner's salary cost. This is like the accountant that owns the firm, and then all the employees. Okay, and what I did was for the owners, I didn't include any taxes just because there's so many different entities. Some are passed through, some are not. But then for the employees, I did include the taxes in there. So this is going to give me my total operating expenses. Then on the third box in the bottom, I put the total number of employees. And what I've done here is I've entered the total number of hours that each of the production employees work. So the owner and the staff members, the bookkeepers, whatever, put them in there. And then the most important thing, I put the billable capacity. So the billable capacity is how many hours of the day are billable time. And most employees are not at 100% billable capacity, because you get to the office and you at 9 and you leave the office at 6, whatever it happens to be, between your first 10 minutes to check the emails and then responding to the emails and putting out fires and lunchtime and the switching time between jobs, you may only be about 80% or 60% productive. And then the owner themselves, they're doing so much administrative, strategic marketing work that they also have a much reduced billing capacity. So what I'm trying to do is I'm trying to illustrate what our effective billable hours is, our actual billable hours that we can put on an invoice would be based on how many hours they work in the month and their billable capacity. So that gives me my effective billable hours here. Then what I've done is a really quick, easy formula where I have taken the overhead, divided it by the number of employees, and then I've taken the direct cost of the employees and divided it by each employee, so it can give me my, quote, effective hourly cost. So then when I figure out what my hourly rate is, my billable hourly rate is, I can figure out what my profit per hour is, and then my total profit, if I were to multiply that times my effective billable hours. And then in the bottom, you get a quick calculation of what that would be. So this spreadsheet is supposed to do two things. One is supposed to confirm that, yes, it could be easy to measure profitability with billable hours, but also it's not, because the challenge of allocating fixed costs and the challenge of figuring out billable capacity, these are fudgeable numbers. I mean, you can insert any number you want in here. So at the end of the day, profitability seems easy, but it is still a subjective number. And what most people think is billable hours are not subjective, because you basically just take what you pay the employee and what you charge the customer, that's the profit. It is not. It is not, because you have to allocate billable capacity and you have to allocate monthly overhead. So that was the point I want to make with the spreadsheet, is make it useful for you, and also give you a general idea of how or just confirm how you probably already think about measuring profitability. So I'm gonna stop for a second and run the first polling question, and ask you, where are you with your journey of value pricing? So what I've shown you so far is the calculation of how most practitioners think about profitability per hour with an hourly model. And I'm gonna get away from hourly model. So I wanted to introduce that, give you the spreadsheet, give you some context, and then talk about the journey to value pricing, and what I feel are the most important elements, points I want to hit. So we have about 23% of you nowhere, you're still charged by the hour, not on the horizon. 46% of you have already started, which is great. And the rest of you are somewhere almost there. And 13% of you are all doing value price, which is great. So for that smaller group, I hope to show you something new as we get into more of the advanced topics. Okay, so let's talk about some common myths and misconceptions of value pricing. Number one, value pricing means we practice price gouging. A lot of people believe that value pricing, it's all about trying to get the most, take advantage of the situation, take most out of the client, just just to play with pricing. And I don't believe that price gouging is actually a problem generally globally, with the exception of during national disasters and stuff like that. I think pricing is the best signal or the best information you can ever have about supply and demand. Pricing is an extremely important tool for you to indicate to the public what the current supply and demand is. So, for example, when people are at capacity or full capacity during tax season, they should be charging more to take in a new client to also put into the list of the clients that we have to get done by the deadline. Why? Because we are full of work. And when you are not so full of work, when you're slow, you're more propense to give a discount or price something much more aggressively because you have less work. Now, is that price gouging somehow? No. Pricing creates the context for supply and demand. And also pricing can shape the behaviors of customers. So if you gave a customer two prices and says, hey, if you show up in January with everything organized, I will charge you $200. But if you show up in April and everything's a mess, I'm going to charge you $3,000. The customer will self-select themselves into the better option based on their needs. Maybe the $3,000 to them is worth something because they don't care about being organized and they don't care about paying $3,000. That's not price gouging. If you charge somebody a premium because they have to do things within a couple of weeks and there's a deadline, that's not price gouging. That's an indicator of supply and demand. So price is an extremely important indicator of what's going on with supply and demand. The other value pricing myth and misconception is value pricing means that you're going to charge more for our services. That's not true. If you practice true value pricing, where you discuss with your client value and what they need, there are cases that implementing value pricing will force you to offer something to a client at a lower rate than what you've been charging before, or a lower fixed fee than the average of what you've been charging in a monthly fee. Why? Because the customer is telling you that they don't value all this extra work that you're doing. So value pricing is not just to increase your rates, is to adjust the work that you do to the outcome that the customer sees valuable. And one of the great services you can do for your customers is identify the ones that you're doing too much for and do less and even charge less and open that capacity for the customers that would pay more. Okay? Because at the end of the day, if you're doing too much for a customer and they're paying too much, they're going to leave you anyway, or they're going to give you bad publicity. So the idea with value pricing is to understand what you do and how much is that worth to your customer so you can adjust your prices accordingly. The other misconception is that as long as I'm offering a bundle or a package fee or a fixed rate, that means I'm value pricing. That is not true. If you don't have a value conversation, if you don't understand what value means to your customer, then you're not value pricing, you're just pricing. Okay, and that's two different things. You can price a package, you can price a service, you can sell a service that's bundled with something else or is a fixed rate, and that may not necessarily be value pricing if you don't understand what the value is to the customer. So value pricing doesn't mean fixed rate, right? Or fixed rate doesn't mean value pricing. When you value price, you should always charge a fixed rate and charge upfront. But just because you're charging a fixed rate and upfront doesn't mean that you're value pricing, because you have to understand the value. So I know it's a lot of repeat, but that's just a really important concept to make. The other one is value pricing is only designed to benefit the service provider. False. Value pricing is designed to service both. It's designed to benefit both. You're supposed to put the service provider's needs and the customer needs at an even keel. That's what value pricing is supposed to be. Okay, let's go through some general rules here. Okay, some general rules of value pricing, and if you follow these golden rules, you'll be gold. And I'm going to deep dive into one of them because we don't have time, but we'll get into more details in my webinar on August 30th. So these are the rules. Number one is all your services have to have a periodic renewal. What I mean by this is that no customer, no service is taken for granted. That means that in every service, every clause, we're either going to revise the engagement 3 months, 6 months, a year later, that's your choice, because every single year, the facts and circumstances could change. One of the biggest problems that a lot of people have is they can't value price their existing customers because they've been charging their customers the same way for 3 years, and the customer is just not going to accept such a big change. Well, your problem was that you did not set the expectation that your services are based in a particular time period, and everything is up for grabs and everything is up for renegotiation, and you're okay with losing the customer. The customer should be okay with changing accountants if you don't agree the next year. Your business, your life, your client's business, your client's life is different from one period to the next. So why should the same pricing and services given to someone at some point in time be the same throughout the year? So there has to be a periodic renewal. The other piece is the services are priced, they're not billed. Just because you charge a client a fixed fee after you did the service and you did not negotiate a price up front, that would not be value pricing. You have to price it up front. If you don't price it up front, you're not value pricing. You're billing a fixed fee, but you're not value pricing. And some people may say, well, Hector, that's the same difference. Well, it's not, because if the client never agreed to a price up front, it always opens up the floodgates of the customer says, what are you billing me for? And when they say, what are you billing me for? Then you have to justify your bill. And then when you justify your bill, you may run into the situation where the customer will disagree with your justification. And then you have to use time, labor, whatever to justify your bill. And then the conversation goes in not the right direction you want. Third one is you need to have a fixed price service agreement. That means that you not only agree with the price up front, but you also write down in a document exactly what you're going to do, what you're not going to do, and what's included with that. I have a couple of fixed price agreements in my arsenal that I can email to you. If you send me an email, I can send you some of my engagement letters that I've done with a fixed price engagement, so I can show you that. But the fixed price agreement is after you have negotiated the price, not for negotiation. So once you negotiated the price and the service, then you give a fixed price agreement. This is the same thing as an engagement letter. The difference is that a fixed price agreement is always going to have a much deeper scope, and it's never going to mention time or an hourly rate. Fourth one is a guarantee. In value pricing, it is implied that there is some sort of guarantee. in the entire commerce, when you go to Walmart, when you go to Target, when you buy something at Best Buy, when you buy something at Amazon, when you buy something from any store, there is an implication that there is some sort of guarantee. There's either a 30-day return policy, there's a 1-year warranty for the service, there is just going to be an implication that the service provider is going to guarantee the work, that is going to support you if something goes wrong. And that guarantee, that explicit guarantee that if something goes wrong, we'll redo it. If you're not satisfied, we'll give you your money back. And I'm going to spend a lot of time with guarantees because that's a really complicated one in my big webinar. I'm probably going to spend a whole 30 to 45 minutes on guarantees. I think all the value, or if not almost all the value of your services is in that guarantee, right? Guaranteeing a result, guaranteeing an outcome, guaranteeing the money back if they're not satisfied, that sort of thing. The fifth rule is value is subjective. And I'm gonna deep dive into that, so I'm gonna skip to the next one. The sixth one is prioritize based on value. That means understanding, and this is a technique that we do with our customer, where we list everything that they want and we reorganize it based on what's more valuable. And then we use that to create our options, saying, hey, if you want something that encompasses a whole list, this will be this price. If you want something that only focuses on the top priority, it will be this price. If you want something that is top priority and some of the low priority stuff, it would be this price. We use a prioritization technique with our clients to figure out how to price our services. The seventh is the value conversation and understanding why. Why is the customer coming to you? Why are you in business? Why are you the best qualified to do the job? I'm going to show you an example of that. The eighth rule is offering options. Without options, you have no context for pricing. Options is the only thing, the only tool that you have to learn how the customer values your services or how the customer values your work. Options are the only tool that we have to gauge quantification of value from a customer's perspective. And we're going to spend time on that on the webinar, and on the large webinar, the 3-hour webinar in August. And then the last one is leveraging and transferring risk. When you transfer risk from the client to you, that's where all the opportunity for profit is. Okay. When you start seeing your accounting business as an insurance company, and I'm not saying you should become an insurance company, but you start seeing the insurance company model, that's where you're going to see almost all the opportunities for profit. Because if you take a risk and something goes wrong, you're going to pay for it, fine. But the law of proportions and percentages is that you're going to take a risk with a lot of clients, and maybe 5 to 10% will go upside down on whatever that risk that you're taking, but the other 95 or 90 that don't are the ones that bring you all the profit. So you have to kind of deep dive in some examples of that, but that's a general principle. So let's talk about value is subjective and pricing is contextual. So value is subjective means that the only person that's a judge of value, it's the individual. So me as the practitioner, I'm the only one that values my own time, right? And the customer, as the customer, as a small business owner, whatever they mean, they're the only ones that place a value on the service that you provide. Your customer doesn't place any value on the time you spend. And honestly, I don't place any value as a practitioner. I don't place any value on the outcome of my work. So my value is the time that I'm spending in my work, and the customer's value is what they extract from your work. So we never are exchanging time for money, and that's a really important piece. Nobody's ever exchanging time for money. The customer never is buying time. The customer doesn't want to buy time. The customer wants to buy the outcome of what you do with your time. So both of us, the service provider and the customer, have different perspectives of value. Now, when I say my pricing is contextual, and I'll show you an example of that, that means that pricing it's only something that you can measure or that you can judge if you have the context, the circumstances, and the comparatives of the alternatives next to it, which is why offering options is such an important piece. The other rule, the deep rule here, is price the customer, not the service. All these tax practitioners that charge per form on the tax return, to me, that's such a flawed business model, because you're assuming that everyone values a Schedule C and a 1040 the same. And that's not true. Everyone has a different perspective of what the tax return means to them, or the work behind the tax return that means to them. So price the customer, not the service. Every customer, every circumstance would be unique. And with value pricing, we take advantage of that uniqueness. This is the one that most accountants throw chairs at me when I teach this in a public setting, is in the real world, debits do not equal credits. In the real world, debits don't equal credits. Allow that to sink in for a second. In the real world, debits don't equal credits. Okay. When I hire someone to paint my house and they charge me $4,000 to paint my whole house, you're making the assumption that painting the house and $4,000 have equal value, right? I have a debit expense of 4,000. The painter has a credit income of 4,000. Yes, from an accounting perspective, it is a debit and a credit. But when the transaction happens, both parties profit. If I paid someone $4,000 to paint my house, it's because I would prefer to pay $4,000 than to paint it myself. I can paint my own house. Now, if it would have cost me $10,000 to paint my house, maybe at that point I say, you know what? I prefer to paint my own house. My 10 days that it takes me to paint my own house is worth to me more. It's worth to me less than the $10,000 that I would give up to pay somebody else to do it. So I much prefer to do it myself. So there's always a point in the transaction where both parties make a profit. If I'm willing to pay $4,000 to someone to paint my house, it's because painting my house to me is worth more than the $4,000. That means I probably could have paid five. I probably could have paid six. There'll be a point in time in which I would have done it myself. Your customers is the same way. Uh, your skills on accounting and tax, your customers can do. I mean, if you learned it, they can learn it. So why don't they go back to school and become accountants? Because to them, the money they pay you is worth less than what they get out of you. And the minute you understand that in the real world, debits don't equal credits, that both parties can profit from the transaction, you will rid yourself of the concept that I'm price gouging or I'm charging too much. If your customer agrees with a price up front and they pay for it, trust me, it was not too much. If anything, it was too little. The only time when you're charging too much is when the customer says no. But every time the customer says yes, you charge too little, because that means they could have probably paid a penny more or a dollar more or $100 more. Anytime your client agrees up front, that means you undercharged, or it means that to the customer, your services are worth more than your price tag. And the minute you get that through your head, you will see the world differently. You will see commerce different. You will see the interaction between the accountant and the customer different. And lastly, the customer is the only judge of value, is the only and ultimate judge of value, but it's not a one-sided transaction. So people say, well, if the customer is the only one that judges the value, isn't it a one-sided transaction? Well, maybe, but if you agreed with the customer up front, then it's no longer a one-sided transaction. We both agreed up front before the work commencement. That means we both agreed that the value that you placed, Mr. Customer, is a mutual agreement of each other. So the customer is the ultimate arbiter of value, but both of us agree to it, or we're okay with it before we transact. And we never have an issue on whether or not I charge too little or too much. The last one on this one is never use cost, labor, or time as a justification of price. Rather, use the price as a justification of labor, time, and cost. Why is Apple worth $1 trillion? Why is Apple the most successful company in the world? It's because Apple didn't figure out how much it costs to make an iPhone and then priced it at a 20% margin on top of that. That's not what Apple did. Apple said, you're going to pay $900 for my phone, and I'll figure out how to keep my costs low. And you can't get a discount on Apple anywhere. Apple is a fixed price. And this is the secret of success. They don't discount and they don't charge as a margin or markup from cost. They charge based on what their price signal tells the world my product is worth. And then I'll figure out, with your profits, I'll figure out how to run my business. So never allow your internal cost to rule or control what your price is going to be. So your customer says, well, you only pay your bookkeeper $20 an hour. Why are you charging me 50? That conversation should never, ever, ever happen. And if you take away the language that we use cost as a justification of price, you tell the customer, that's not how I function. I charge my services and I figure out how to run my business. And if you want me as an advisor, I'll show you how to do the same. What a great thing to do is to lead your customer by example on how to be profitable. Accountants should be the most profitable business in the world, so they can advise their clients to be the second most profitable business in the world. So first and foremost, your duty is to be profitable and run a profitable business and price up front and just justify the cost after price. So then you can show your clients how to do the same. So they're not struggling, because every business that's struggling is because of that, because they try to use cost, labor, and time as a justification of price, and they price wrong. Most companies say we have a cost problem. No, you don't have a cost problem. You have a pricing problem, and it's always, always a pricing problem. Okay, so let's move on to a specific example of the context of pricing. Okay, the context of pricing. So let's think about whenever a new accountant comes to a customer and says, I'm going to charge you $1,000 a month. Now, if without any other information, that number doesn't mean anything. Maybe it's a high number, maybe it's a low number. But what happens if we start comparing it with what the old accountant used to charge? Okay, so now we have some context, right? The old accountant charged 500. The customer's not satisfied with them. They want a new accountant. The new accountant cost 1,000. So now we have more information. The customer has a lot more information to decide from. But what if we replace the context of what the new accountant charges and the old accountant used to charge with the value they get out of $1,000? So with the new price of $1,000, the new accountant will give back to the customer 16 hours, 14 hours back for them to concentrate on their business. With this new accountant, with this new service, the owner only needs to spend 2 hours a month dealing with accounting instead of 16 hours a month of dealing with accounting. And this is the most common thing. People hire accountants because they don't want to deal with it themselves, because they want the time back. And if you could figure out the output of the owner, and by the way, the business owners typically are the biggest output people. That means that if they're out there selling, marketing, developing business, talking to the customers, they're always bringing more revenue, more sales than their employees do. So we can justify that giving the business owner 2 full days, 16 hours back to be on the field, to develop business, to make their business grow, the business owner could essentially now bring in 25,000, just to say a number, $25,000 more in sales per month. And all of a sudden, the context of $1,000 accounting service versus $25,000 in additional sales, it provides much better information than the old context of the new accountant's price versus the old accountant's price. So it's these techniques, is this mindset of discussing the value, the outcome from your work, that really make your price a non-issue with your customers. Now, what if we were talking about options now? So what if we were now offering the customer a new service for $600, and we give it a label? And this to me is one of the most important techniques, is your services have to have a label, and that label has to provide the context of the service. So if I'm going to offer 3 options, I'm going to offer 3 services. I'm going to call the first one the basic services. Just say a name. Basic service, $600. Now, when I use that with context, now I'm comparing $600 versus my old accountant that charged $500. The only context here is the new accountant, it's slightly more expensive than the old accountant. But what if instead of just offering up one price, I'm now offering more options, and I have labels that makes the customer that the customer feels for, right? So the new label is Power Report Service, $950. And then the third label is, for example, just throw a name, Total Compliance Guarantee. By the way, your biggest option should always have the word guarantee in it, because they need to imply that that's the golden option, right? The golden option, okay? The total compliance guarantee is $1,500. So I'll let you think about that for a second. Let me run another polling question real quick. And then while that polling question is up, I'll answer some of the questions, and then I'll get back to the context of pricing after the polling questions are answered. So somebody says, do you have a list of services and that you can offer to your customers so they can check the box, so to speak? So Brian, the answer to your question is, I do list all the services. I do list all of them. I'm going to show you a slide, or the last slide on a pricing tool that I use. And it's not really a tool like a software. It's a conversational tool, and it will give you some idea. So maybe I'll answer that question on the next couple of slides. Alexa says accountants should be the most profitable business in the world. You're right. Yes, I know I'm right. Brian says, what would you offer in a basic service package? Again, I'm not here to tell you what you should be offering in these services. This is up to you. This is all personal and contextual to your own practice. You know, your middle service, your big service, your small service, that should all be personal to the customer's needs. I don't want to tell you what you should offer in each one. I'm going to give you an example, and that example I think will provide the most context. Okay, let me go ahead and close the poll, and I'll show the results real quick. So 50% of you said that having a value conversation, understanding the value perception, pricing services to match the value, and creating more value for your customers are all equally difficult. The only one that really won this is matching the services to the price. Okay, so that one may come in a little bit clearer on the next example. So again, I was saying the context of pricing, when you offer the three options, now all of a sudden I'm no longer comparing the new service with the old service. I'm now comparing the old service with three new services. So I just increased my chances from a 50-50 chance now to a 75-25% chance of nailing it. And then the customer starts forgetting about the old price, and because the old price is so non-contextual anyway, the new context of the price is within itself. So before, when we were trying to figure out how to win a customer that used to pay $600, that used to pay $500 versus the new service of $600, now the customer is trying to figure out how they should work with you. So you're changing the conversation or the sentiment to, you know, should I work with you, to how should I work with you. So I think that's the importance of pricing and the importance of providing those labels on that pricing. And of course, in your value conversation, you will have discussions around that. Now, I want to tell you something else that will just kind of flip your brain around for a second. Think about it the other way. Think about if you still had the old accountant pricing, but then you offered them in a specific order. You talk to your client and these are my options. Option one, total compliance guarantee service, $1,500. This is going to include everything we talked about. Okay, so everything we talked about will do everything, right? Total compliance guarantee will guarantee it. You will be 100. Anything you need will be covered on this. By the way, the dollar amount is obviously just a number. It will be, you figure out what your number is. So now the new context before you present the other ones is the old one of 500 with the new one of 1,500. So what you want is for your customer to immediately feel, wow, I will love this, but I can't afford it. What you actually want is you want your customers to immediately feel that your top service is something that they want and they can't afford. And that's part of the process. That's part of the context building. You immediately need that customer to want your service and put the guards up and say, well, I can't have it anyway, because that's going to provide the anchor or the context to the value of the other services. And this is how we quantify, and this is how we justify the value. Okay. So the next one is the same middle service, power report service for $950, whatever you want to call it. Now what you want the customer to feel is, I'm considering this because this is a much needed perk that I need from my accountants. Okay, so a much needed help that I needed from my accountants. It's going to be covered in this power report service, and I really want this. It's much more expensive than what it used to be, but it's something that I would consider. So you want your customers to automatically not put the guards up saying I don't want this, saying I want this, but I'm not sure if I can afford it. And then when you present the lowest option, that should always be slightly more expensive than what your old accountant is, because if they're coming to you for wanting to switch accountants, it's because the old accountant really didn't help anyway. So you want the new service to be slightly more expensive, the new basic service, and you want them to feel, well, this is an improvement from my old accountant. And then all of a sudden, when you present it this way, they forget about the old accountant, and now their new context is the three options. They're going to be gravitated towards the middle option. Remember, the original feeling is they really wanted the top option. So at the beginning, they discarded it. But now that they have discarded the old price, now they have the new three prices as context. So now it is the three new prices that become the context. Again, switching the conversation to, will I work with you? Or should I work with you, versus how will I work with you? Okay, so let's talk about qualifying the value. Okay, so I think this is one of the most powerful techniques that there is during your value conversation. And of course, this requires for us to go a lot deeper, but just as much as I will give. When you're talking to your customer, there's a couple of key words that you want to be listening for. So when your customer is explaining to them their needs, their issues, their challenges, how their business works, you want to hear the word sales, revenue, cost, customer satisfaction, quality, performance, speed, productivity, production, sales, close rate, repeat business, attachment rate, gross margin. Any of these words, anytime any of these words come along and in your customer's conversation, you should immediately write it down, immediately have bells and alarms all over your head saying, this is something that will help me quantify the value of my work. And then what you do is you break it down and say, okay, you said that you have elevated costs in so-and-so area. You said your cost of production is too high. Okay, so the customer said my cost of production is too high. Let's take a look at this. How do I measure the cost of production? And you have a conversation around that. Figure out what measuring stick we have available to measure the cost of production. What is it now? Okay, let's write it down. What is your current cost of production? So we know how to measure it. We have our expense reports. We have a profit and loss, whatever. And let's say, what is the number now? What does that number look like now? Then the next one is, what do you want it to be? Like, so if I could wave a magic wand and the services that I provide help me reduce that production cost that you mentioned to be a pain point, what would you want that to be? So the customer says, okay, I want it to be, 30,000 instead of 40,000. So now we know how to measure it, and we have clear rules around how we measure that number. We know what the current number is now. The current number is 40,000, whatever. We want to get to 30,000. Then we want to say, okay, what's the difference? So the difference is $10,000. And what is the value over time of that $10,000 a month or whatever happens to be that we're saving that customer? So now that we understand that what the customer really wants from you is not an accounting service, what they really want from you is the equivalent of $120,000 a year in production cost savings. Now we have much better context in terms of how we quantify the value of our work. You can use any examples like tax penalties. Well, how do we measure tax penalties? We get tax letters. What is it now? Well, let me show you all the letters that I have. What do you want it to be? You want it to be zero. What's the value of the difference? Well, it's, the whole amount. How much would it be worth to you that you don't have any tax penalties in the next 3 years compared to what you had before? You can use anything, any number that's measurable. If you go through the 5 golden questions and the let's get real or not let's not play book kind of surrounds the premise around this. If you can ask these 5 questions, you will know the value of your work every single time. Okay, and it'll be easier for you to price. Okay, let's run through the 6 opportunities for creating value. And we will not have time to get into the details of this, but I think these are the 6 times or the 6 opportunities you have to create value. Positioning. If you specialize, if you only do one type of customer, if you are the most expensive, if you only work a certain way, if you are in a specific geographic location, if you don't work with a specific group of customers, if you have ground rules in terms of what you do and you don't do, that's your position. And the customers value that. okay? Especially if you're an expert in a very specific topic, that's positioning. Understanding or scoping value. This is the value conversation, okay? So you will create a lot of value through your conversation. Whenever your customer says, this this accountant gets me, this accountant understands me, that's a lot of value, okay? I don't have to explain things twice to this customer. That's a lot of value. Okay, so that understanding and scoping value is it's a huge opportunity during your scope of work that you have to create with your customer. The performance or experience value, this is the best example I can give you is table side guacamole. Guacamole will cost $8 in every Mexican restaurant. Table side guacamole is $16. Why? It's the same thing, the same ingredients. The difference is there's performance or experience value on watching somebody do it right in front of you. This is why your most premium and most expensive service should be the one where your client watches you work. So when you want to give your client options and says, you want me to show up? You want me to do it with you? You want to watch me work? It will be this price. You want to send me all the stuff and I do it in my underwear at 3 o'clock in the morning whenever I please? It will be that price. There's a lot of value in the performance. There's a lot of value in the experience. You want to really, really keep that in mind. The results value, of course, this is the results of your work. That's the Mahan Khalsa questions that we said. How do we measure it? What is it now? What do you want it to be? What's the value of the difference and the value over time? The results value, that's how we quantify our work. Membership value is the value that they extract from being associated or being affiliated with you. One of the best things that you can do is convince your customers somehow through your marketing that being associated with you and your firm is valuable, right? You're part of a club per se. And the last one is the tail value or the post-service value, which is the value that you generate by giving the client the trust and the confidence that even after the service is done, you will be there to solve any future problems. Let me launch the third polling question real quick. For the CPE people, the third polling question. Okay. And let me see some of the polling questions we have here. Alexa says, as a bookkeeper, I hear people say you cannot value price a commodity such as bookkeeping. The issue is figuring out how to add value services beyond compliance. Alexa, one of the things I tell you is one of the myths is that in order to value price, you have to do more services to your customer. It's not always the case. You can value price. Look at the 6 opportunities to create value. How much of it it's under the results value or the value of outcome? I've given you 6 opportunities that you can think about for creating value. You can create value just by being the best in a particular subject matter. You can create value with marketing. You can create value simply by understanding what your customer is talking about. You can create value by the performance that you put, the show that you put while you do the work. You can create value by giving somebody a guarantee or giving them tail value, which is, guarantee that if something goes wrong. You can generate value in so many other ways other than simply offering more services. I think a lot of us get stuck in this concept of offering more services and what else can I do? What else can I offer? And that is the only possible way to add value. I think that's false. I think that may be the wrong way of looking at things. Okay, just to share the results real quick. You guys are most excited to talk about how to create value that customers recognize, which is what I'm discussing here briefly. And the other big one is how to offer options and packages to your customers. We're going to cover that in depth in the big value pricing webinar. Of course, I'm not trying to tease you or give you short information. As a matter of fact, I think I'm packing a lot in this 1 hour. But obviously, these things have to be dug deep, and we have to go in a slower pace and work with some examples. But think about that this results value or the performance value, which is what people think to be the services that we offer. Okay, that's not the only place to offer. Not the only place to offer value. You can offer value in many places around just the service that you offer. And I would argue that is the biggest opportunity that you have, and probably the most important one that you should be thinking about for the future. The things beyond the extra services that you offer. Okay, so I'm gonna skip the power of why, and I'm gonna talk about pricing complex projects, because this is the most valuable thing, not to play on words, that people the feedback that people tell me that says this is for sure the best thing the best thing that you ever teach, Hector. So real quick, a typical complex project is the one that's a messy QuickBooks file. We don't know if the balances are right. We don't know if we have all the documents. Income accounts and expense accounts are all over the place. Chart of accounts is a mess. And everybody tells me, well, Hector, how am I supposed to price a project that is complex, or a project that I don't know the scope? How am I supposed to price something that I have no idea how long is it going to take me? So this is the technique I will give you. This is called Chris Marston's concentric circles of scope. So what you do is you break down all of the possible things into 4 groups: yes, likely, maybe, and who the hell knows. Those are the 4 categories: yes, likely, maybe, and who the hell knows. And what you do is you sit down with your client and say, well, I don't know how to price this, but let's figure it out. Let's talk about your project, and let's together figure out exactly what you want me to do. Yes is what I know. I know you have 3 bank accounts. I know it's 200 transactions a month. I know it's 50 handwritten checks. I know another account that handles the payroll. Likely is what is likely to happen. A new account shows up, number of transactions increase, some cash transactions show up, a letter will be sent for someone for us to review and give them some sort of advice. Maybe are the things that from experience, it tells us these things show up. Maybe you open a PayPal account. Maybe a new person starts writing the checks and I can't understand their handwriting. Maybe we need to reconcile some other accountant's report that comes along just because we couldn't come up with it in our original scope. And who the hell knows says, who the hell knows? Maybe you'll switch to a Mac and I have to deal with your Macs. Maybe you'll have a Bitcoin account. Maybe you'll get an audit and I have to deal with the audit, and I have some document retention techniques, situation with your audit. Maybe we'll have some new coolest person touching your books and making a mess. So when you're having this conversation with your client and you go through the stuff that I know for sure, what's likely to happen, what may happen, and who the hell knows, when you're having that conversation, it provides context to how difficult it is to price a complex project. But when you have this conversation in this order with your customer, inside in your head, you have to calculate how long it would take you to do everything that's listed there. Everything's there, based using your own hourly rate. In your head, you're going to figure out, using your own hourly rate, how long it would take you to do everything that's on this list. And you're going to write it down. And then what you're going to do is you're going to assign a percentage of likeliness to each of these groups or buckets, and you multiply that times the hourly rate that you have. So when you internally say, look, I for sure know that I'm going to do this and I would price this at $500. It's likely that this second bucket of things will happen. I would price this for $250, but there's only about 60% chance of it happening. So now it's $150. And then maybe this will happen. I will price that at $500, but there's only a 25% of the chance. So you kind of see how it is. So it's actually very easy. It's actually very easy to price a complex project if you use your hourly rate, attach a percentage probability to it, and give it a fixed effective price. So I know I breezed through that pretty fast, and I apologize, but we're running up in time, and that's something that I will dive deep into that. Now, I have a question that says, Hector, how do I sign up for your value pricing class? So you go to valuepricing.net. That will take you to the website here, which is my value pricing course. You would click on enroll this course for $300. You would put once you click on that, make sure you use the coupon code AUG15. That will give you a $50 discount. I have to make sure that coupon works. I'll double check in my course page to make sure that works, but I guarantee you I'll have it working sooner rather than later. So you put that coupon code there, it'll give you $50 off, and you have to sign up before August 15th. You'll have access to all my pre-recording videos on value pricing, which contains all this stuff in detail, plus the live webinar I will have on August 30th. And it's limited to 50 people because I actually do want to take the questions. I do want to have the conversation. So I'm making this small enough. We already have 35 people signed up. So we came into CP Academy to share this. And also, I think we'll pick up the next 15 in the next couple of days, and some of you will probably sign up today. So let me see. I don't think I have any other questions.
Hector, there aren't any other questions, but we are just about out of time and still have one more polling question left to trigger. Is it all right if I go ahead and launch that?
Yep. Go ahead and launch that. Perfect.
All right. So this is the last. Oh, and the last polling question just closed. So Hector, did you hit the polling button?
Probably by mistake. You wanna set up another one real quick? It wasn't on purpose.
I am going to try to as quickly as possible because we want to make sure that everybody has as much ability to qualify for CPE as they.
While you do that real quick, there's a person that had asked me about the whole process. So somebody had asked me, are these 4 buckets 4 options? And the answer is no. Those 4 buckets are actually designed for you to assign the probability that something that's unknown will happen. And I'll do this while Jason gets the polling question up. It is simply to assign the probability that something may or may not happen, but you have that conversation with your client so the client knows and understands, how complex or how easy, how difficult it would be otherwise to understand exactly how to fix price something. So I think that having that conversation with your client in that order, by the way. So yes, likely, maybe, who the hell knows, have that conversation with your client so your client understands that it may be impossible to know exactly how much any particular work is going to be just because of what you said. It is, all these things are possible. And the other really important thing that I like on that technique is that when you use that technique, the client really usually is pretty impressed with your process, and your client usually says, you know what, you have experience, you've done this before. It is obvious that this is unknown for everybody. This is unknown. We none of us know exactly how much this work is going to be, but by you telling me all the things that you know for sure, what's likely to happen, that maybe happen, that's a testament. It's a true testament that you had experience, that you've done this before, and your customer gets increasingly gets more trust towards your judgment. And then when you give them a price, they feel that you had a much more mathematical approach to coming up with the price rather than just using some arbitrary numbers. So I strongly believe that using that approach will render the best amount of results, especially for complicated, complex, unknown scope projects.
All right, Hector, we're just about at the end of time. I just want to let everybody know that I put the link to Hector's upcoming webinar, his deep dive, in the chat panel of GoToWebinar, along with the promo code. So if anybody wants to copy that down or click through the link, now's a great opportunity to do so. I'm going to go ahead and close down this polling question. And since we are just about out of time, first, Hector, I want to say thank you so much for presenting. It's always an absolute pleasure having you on the platform. I think we have some new converts to the Hector Garcia fan club today. And everybody, again, the link to Hector's upcoming deep dive webinar is in the chat panel. We'll be processing your credit by the end of the day today, and you'll have that in your account along with the handouts and an archived recording of this session. So for all of us here at CPA Academy, for Scott and myself, thank you so much, Hector. Thank you all for your attendance. We hope to see you all on future webinars.